many events do you do over the course of a month?
3 or 4, I think. Hi, everyone. We are live for this event with Veronika and Dietmar. Thanks, everyone, for joining us today for the CFO Connect webinar. We will wait a few minutes to allow people to connect. As usual, for those that have been with us for a couple of webinars, you can introduce yourself in the chat, say where you're from, and then we'll get started. Who will be the first? I can see Olaf typing. Will you be the first one sending the message? That's a question. Hi, Olaf. You are the first. Welcome. Thanks for joining us. Hi, Moritz. Hi, Stephen.
Many more coming in.
Exactly. Munich, Belgium. So tonight, it's a webinar that's organized by CFO Connect. So I'm Faustine, and I'm in charge of the CFO Connect community. So CFO Connect, it's a community for finance leaders in Europe and in the United States. And we organize a lot of events like this one. We're just talking about it just before pressing the live button. So normally we organize around 3 events per month on different topics. Really stay tuned for our invites. So we do a lot of events. We have also some content. Veronika did write a piece on our blog. So if you want to check it out, go on it, cfconnect.eu. And we also have an online community for finance leaders to stay connected on a daily basis. CFO Connect was a community that was launched by Spendesk in 2018. And Spendesk, it's a spend management solution for finance team. And tonight, we're going to be talking with Veronika and Dietmar about asset-based and inventory-based financing. I'll leave them introduce themselves. They'll present and discuss for about 20-25 minutes. And at the same time, really feel free to ask your questions in the question tabs. And we will also have a more formal Q&A section at the end. I'll give you the mic. Veronika, do you want to start presenting yourself?
So hello, everyone. I'm glad you all could join. I'm Veronika. I'm CFO of Cluno, who is a subscription provider and a startup, which I joined in 2018. Dietmar, up to you for a presentation until we kick off the official part of it.
Thank you very much, Veronika. My name is Dietmar Helms. I'm a partner in the International Debt Capital Markets team of Hogan Lovells, one of the leading law firms, and I'm based in the Frankfurt office. I've been doing structured finance advice for more than 20 years, and for the last 7 years have focused very much on fintech companies and also companies such as Cluno, and help them getting access to debt financing to support their growth.
Thanks for joining us. I'll leave you kick it off, Veronika.
So maybe, so you understand Cluno's business model a bit better. Cluno was a German startup, kicked off in 2016, went operational in 2017, and was acquired by Cazoo, the online car retailer from UK, by the end of February of this year. There was a whole lot of press around this. I won't detail it, but Cazoo's mission is to transform the car buying experience across the UK and Europe. And car buying also means car subscription to them. So the Cluno team in Munich will actually roll out both kind of business sectors, car subscription and car trading over Europe. We won't discuss much about car trading today because this is not a model that is very complex in asset financing. However, I do need you to understand the basis of subscription. Subscribing to a car is pretty similar to renting a car. However, for a longer period of time, you can book our cars online on our mobile app or on our website. It's very easy and it's an all-inclusive price, which will also cover the cost of maintenance, of warranty, of tires, of car insurance, tax, and all the pretty little details you would have to do if you indeed own the car. So from our side, the advantage is that from Cluno and Cazoo combined value proposition, we can attract more customers who are just interested in the car market. We can make a larger inventory of cars available to the market, and also we can have very scalable operations when it comes to car delivery, to car refurbishment, and the like. On the financing side, this means we have a whole vehicle life cycle for the cars in both the subscription part of the business model and in the trading part of the business model. For the subscription side, we buy a car with an OEM or a dealership. We store it for a short time until we sell the subscription to a customer. And at that point in time, we'd register the car, we deliver it to the customer, we do the whole fleet management stuff, we manage damages, tire changes, maintenance events, and the like, until that car is defleeted. Defleeted can mean two things now. Either it's sold via the Cazoo website to private customers, or it's sold back to the dealerships or OEMs if they had entered into a buyback agreement previously. Also, on the trading side, there's a certain need to refinance the cars because obviously coming from subscription or even being bought new from, not new, but used from a OEM or dealership, they would have to be refurbished. They would have to be waiting for the right customer. They would have to be delivered to a location near the customer and then either picked up or delivered the very last mile in our Cazoo transporters. Also, that part of the business needs refinancing. However, that's not what we would cover today. Over to Dietmar, who will explain the general success factors for asset-based financing, and we'll go over details of our business model in the second part of the presentation.
Thank you very much, Veronika. So the sharing economy is really the flavor of the season. We really see a trend that people no longer buy everything they want to use, but they rather use the rental of assets from providers such as Cluno. We don't see that just in the car space, but you also think about mobile phones, all sort of electronic devices that you can rent from companies such as Grover, a Berlin-based startup companies that we help finance their assets. Think about Everphone, that is a rental company for small or large companies that want to rent their phones that they use for their employees. And think about the e-scooter companies that we see more and more that have a huge fleet of scooters available all around Europe. And this is then more a short-term rental, but nonetheless a rental business, a sharing economy type of thing. So finding the right financing solution is obviously a key factor for the success and the growth of the company. And apparently it's not very efficient to finance such a fleet using equity. So we try to find the best suitable debt finance available and to also find the best match, the best finance provider for it. When we talk about debt financing, it's not only asset-based financing that we chose in case of Cluno, but you can also think about other debt financing solutions such as factoring of receivables. You can think about secured lending, venture debt solution, leasing, and then finally asset-based lending. So it all depends on.
Dietmar, you're in mute, sorry.
Sorry, I'm still on mute.
Yeah,
Okay,
you ended
at
it all depends on which kind of financing you use.
Yeah, it all depends on the kind of financing, which kind of asset you want to finance, which finance solution is the best suitable for your preferred debt solution. So if you think about assets such as cars, they are very fungible assets. And what is very important is that you have a very predictable residual value at the end of the term when you want to return the vehicle. And this is one of the key factors if you want to find an asset-based lending solution that you can really predict, ideally every month, the value of your portfolio of the assets that you own. So in case of vehicles, we obviously have a lot of publicly available data. We have databases in different countries where you can find out what's the price of a 1-year-old Volkswagen Golf, for instance. It can be more tricky in case of other assets. In case of consumer electronics, think about an old iPhone X you can find on eBay, and they are traded in so high numbers that it's also easy to find out the day-to-day value of such a phone. But we also see a lot of new assets which are now shared, such as e-bikes or e-scooters, where it has become more tricky to really find a suitable source for determining the residual values. So you can search on websites such as eBay to find sufficient data, or you can, in case of Tier, one of the major e-scooter providers, also try to set up your own resale site on the internet to sort of provide sufficient data for a financing solution. And second, it's also important that you have a secondary market for those assets. So in case of cars, obviously there's a lot of trading going on with used cars. But sometimes we also are approached by companies that have very bespoke assets. I had one company that is renting out control units for heating systems. So this might be suitable for a certain type of user that just needs this specific item. But if you think about reselling a portfolio of those used control units, it might become very difficult for a bank to sell that in a large quantity. So we really try to analyze for which kind of asset the best debt financing is suitable. Back to you, Veronika.
So what we present in the following are a few examples from the refinancing pitch deck we also offer to our banks. Starting with the first success factor, which Dietmar mentioned, this is a scalable legal structure. In the most asset-based structures, you won't be able to have the assets in your operating company, the company that has the customer contacts, the employee contracts, also your operative contracts such as office leads that has the IT equipment and other stuff. And why is that? Well, the bank obviously wants to have a certain say in what's happening with the assets. And the easiest is if they take the assets and all associated cash flows and put them in a separate company. That company is called the FinCo, financing company, and it will be ring-fenced, which means it's insolvency remote from the operational company or the OpCo. That means also that both your customer contracts and the assets must be transferred to that company, and the contracts must be set up in a way that they are transferable, or else the customers or the suppliers of the goods would have to consent to each transfer individually. And obviously that would be possible if it was only one big chunk of goods, such as let's say planes, but it won't be possible if it's smaller consumer facing items. So you have to have terms and conditions that allow for that. Then the bank or the note holder, as it said, will hand out a promissory note or something similar. It will finance the financing company with a certain amount of the value of the assets, which is called loan to value. The financing company will receive the monthly amounts from the customers, and it will use them to pay interests and also, if allowed so, the principal credit back to the note holder. One of the other specialities, let's say, of such a structure is that in the case the OpCo went bankrupt, there would be a party who would be able to operate the FinCo so that the note holder could recover a big chunk of the credit. And that party is called a backup servicer. That would have to have an IT infrastructure which allows for servicing of the contracts, and also they would have to get regular data dumps so they always have the most accurate information that's possible. One of the other examples Dietmar gave was the topic of asset pricing. And you see here one of the most simple things. It's a pricing comparison between the cars Cluno buys and an external valuation company for cars. This is called DAT, Deutsche Automobiltreuhand. Similar would be Schwacke or Autovista, as they're called, all over Europe. And they offer external market pricing. And with their prices and our prices, you can draw a chart similar to the attached to prove to the bank that you're buying the assets at a sensible value, and at the end of the credit term, the sales proceeds of the asset would be at least enough to pay for the remaining credit. And that's a good information to them. A buffer of over 20% is really considered high, and it makes the bank more secure that the assets they finance really hold intrinsic value. Another success factor would be recurring cash flows, which we show in the next example. So for a subscription model, this is fairly simple. You have a purchase price of the asset, and then you have a first subscription that generates a certain amount of cash flow. In our model, that's our minimum term, and it's modeled in a way that this covers a certain amount of cost. This is a first small column, a 6-month minimum term. However, from our retention data, we know that each car finds a second customer if need be, and also customers renew their subscriptions or use the cars longer than they had originally intended. And that is creating additional cash flows, such as modeled in the second pink column. At last, we have a buyback agreement for each car, whereas an external party, so not tied to a potential insolvency of Cluno, would buy the car back at a certain fixed price that is known already today. So we also know that third chunk of cash that would be coming in to the FinCo at a certain point in time. And if we add up those 3 columns, we would have an overcoverage of the purchase price. Well, obviously we would have that because Cluno is making on a margin on each car, and we're not selling them because we're good people, but because we want to earn, right? And that margin also adds up extra security for the bank. They could keep it until the credit was completely paid back. One last success factor is the one that might be bugging most startups most, because it's about documentation, policies, boring stuff you simply have to do. So I'm not proud of us doing it. However, I know that we have to. And that's why we set up our finance function in a way that we allow for bank-like processes, starting with a credit policy and a collection policy. We don't hand out the car to a person that is not properly identified, that don't have any regular income, which they have proven via pay slips and all the like. We have a collection policy. So if someone is not paying his rent, they get a call, and they get a second call, and they get a million of emails, and then it's handed over to external lawyers to finally clear it. Credits are decided not by the say of one credit manager, but alongside an automated scorecard. We have a segregation of duties. So if a sales manager wants to hire a customer, well, they can't, because there's the credit department telling them that we have to do the credit check first. We do full identification of each customer, and we also check the dealers, so those who are giving us a buyback agreement, so that it's made sure that they can, in the course of 1 year, 2 years, really make that buyback agreement work and don't default before. On the portfolio side, well, you have to get a grab on your assets. I believe that's widely differing from the kind of assets you're selling. Obviously, you would have to be in close contact with the OEMs. That's true for cars, but as well for phones or for all tech stuff. You would have to know beforehand when there are new models coming and the like, and that would allow you to minimize the risk. You would have to run a strong data department, for example, projection of future prices, projection of your future need, a good purchasing policy and the like, to allow you to make good spot deals and align them with future demands of your customers. These are just a few examples and very finance-driven examples we wanted to present you. I'm sure it's not the same for each company and for each startup that has come up with such an asset-based financing. However, very open to discuss. If I see Benjamin on the chat, so maybe that's a good moment to open up for questions and maybe also discussion with those participants who have also thought about or even introduced such an asset financing in their companies.
Maybe one last remark from my side, Veronika. I think the structure that you have shown before is particularly interesting because it's a very scalable structure. Whilst it can be quite difficult, cumbersome to get security over particular assets in different jurisdictions, this model with this special purpose vehicle holding all the assets is very universal. So we can use that all across Europe in different jurisdictions, which allows companies such as Cluno to really build up the portfolio, not only in Germany, but also expand to other jurisdictions. And I think that's also one of the plus on this structure here. But happy to hear from our audience and get any questions you may have.
Yes, everyone, really feel free. Benjamin, if you have any insights to add to that. I did see two in the audience. I don't want to name people, but there was someone that used to work at Tier. I know that you mentioned them, Dietmar. So if ever you want to share your experience too or ask any questions, feel free to.
Glancing at many of the company names in our chat, there are quite a few mobility providers. So I believe maybe you're thinking about how you could offer your offer refinancing to banks. Glad to hear about how that's done. I see the first question coming up. What are the main drivers of decreasing interest rates in such a model? Moritz, that's a good question because the easy answer is I don't know.
You do know, Veronika.
well, let's put it otherwise. For me, the starter is how can I get debt in as a startup? Because if you don't have a 3-year-long credit history, if no bank can allocate you in their scoring policy, you don't get any credit at all at whatever interest you're ready to pay. So first, to me, is getting any credit and a lot of credit, and then looking after the interest rate. The interesting thing for the bank is tied to the rating of the company they give the credit to, because usually they do a risk-based pricing approach, and that means if they perceive the risk of the structure small, then the interest will be lower than it would have been a company credit on you as a startup. You certainly know venture debt, that's a pure company credit on your risk as a startup, and rates are between, let's say, 10 and 20% roughly. That's because the venture debt providers are rating you as a company, and they know that startups have a certain failure rate. And that's why they have to make the interest expense very high in order to guarantee that at least some of the startups can pay back the credits of all those who defaulted in the middle of the process. However, as shown before in the structuring, a good asset-based structure is set up in a way that makes sure that the credit will pay back whether the startup still exists or doesn't. And that's made sure by the backup servicer, by the custody documents, by the security trustees, and also by all those pricing things of the assets. And I believe that's driving down the interest once you have a single lender bank. What you can do advancing, well, you can take multiple lenders to one FinCo, and the ultimate goal would, of course, be the fact that you can make them capital market ready, and then the capital market would guarantee in such an advanced structure an interest rate it saw fit. Of course, both the models, our small one and the big one, a capital market one, go with high setup costs? Dietmar would say no, but I say it's high. However, once you have the structure set up, it can be a rolling structure, and you can use it for 20 plus years if each party wants so.
And I see there are two other legal questions that I may pick up. There's one question, is Finco or OpCo having the contract with the customer? That really depends on whether we have long-term rental agreements, like in the case of Cluno or in the case of Everphone renting out mobile phones, or whether you have very short-term rental contracts, such as an e-scooter company where the e-scooter is just rented for 5 minutes when I take an e-scooter in the morning to go from my home to the train station. And so it's not worthwhile selling those contracts to an SPV. So in that case, we would have a master rental agreement between the SPV and the OpCo, and re-renting or releasing the assets back to the OpCo, which will then have the ultimate end customer contract in place. But in case of long-term rental agreements, we try to really shift them over to the SPV to provide additional credit protection for the investors, so that even in case the operating company becomes insolvent, the rental agreement ideally stays in place and will provide for additional cash flow for a few more months. And then there was a second question from the same person. Banks have the pledge on Finco shares or the vehicles and the customer contract, or both. Yes, typically we will have a full-blown security package. So that means all the assets of Finco's bank accounts, rental receivables, the assets themselves are pledged or assigned as collateral for the structure. Sometimes also the shares in the Finco, which is less relevant, I would say, from a credit perspective. But the idea is to really have it full-fledged ring fence. The nice thing is that by this structure, we keep the operating company sort of out of the picture. So you won't have any security on OpCo's level, which is very different from venture debt, and which allows companies to really grow the portfolio and add different lenders into the same structure by dividing their asset portfolios in different SPVs, which is one of the main benefits of this structure. And then there's the question for you, Veronika, who's buying the car back at the end of the contract?
Well, that depends. If you have a buyback agreement, which means a dealer or an OEM offers to buy the car back, it can be them. A buyback always is a put option. So basically the company can decide if it wants to sell to them or if they want to sell to the free market. Usually the free market would be the better alternative because, of course, the OEM plans on making profit even out of the buyback agreement. So the buyback agreement is rather a security to the bank and not a viable economic option if you want to make money out of the car sale. The operational part of it is basically a legal consideration on our side. We said that it won't be the Finco who sells the cars off, but the OpCo buys the cars back from the Finco and buys them back in the amount of the remaining credit, so that the Finco is the Finco is safe, the credit is paid back, and the OpCo can then decide in which model to sell the cars, at which price they want. And in that way, we'd also keep the Finco clear of all warranty and maintenance and stuff risk. Because if the Finco sold the cars, especially to private consumers, if they had any claims because there were damages that were not stated in the purchasing documents and all that stuff, the Finco, and that means the bank, would run certain risks which we don't want to have. I guess Nico's asked another legal question. Banks have the pledge on Finco shares or the vehicles or the customer contract? Well, banks have a pledge on everything they can probably get their hands on.
Yeah, that's what we answered already. There's another one for you, Veronika, which I see on the top if you scroll upwards. What are your experience with heavy vehicle where a public tender authority leases out to a mobility company?
Unfortunately, I didn't quite get that question. Heavy vehicles is something like an MCT, like a trailer. And the public tender authority would lease those cars from a mobility company? Unfortunately, I don't get it. Maybe you could
Stefan,
rephrase it,
Yeah.
or turn your mic on if you may, and just explain to it what's the question about. I'm sorry.
Don't worry, Stefan, if you can maybe add a couple of notes in the chat. And in the meantime, we can maybe answer another question, whether you want to pick up on Olaf's question of Moritz one.
There's another one for you, Veronika. Did I understand correctly that by using the discussed ABF method, Cluno received all funding from a bank?
All funding is unfortunately not correct. If you make that calculation on the individual purchase price of a car. So the bank would keep a certain security that's called loan to value. For example, if we buy a car for 10,000 euro and the loan to value would be 90%, we would get only 9,000 back. The rest would be equity. And in advanced structures, such as we are currently preparing, you could, of course, minimize that equity usage, for example, by bringing in a mezzanine capital partner. I don't think you will reach 100% at first, but also the loan to value is something to be renegotiated. For example, if a structure is running well, if you can prove to the bank that your remarketing is successful and you can sell off the cars at a certain upscale price at the end of their lifetime within the structure, they get more security, and that will make them, potentially agree to a higher loan to value.
Then there's one more question. There's a service agreement between OpCo and FinCo, or how do you transfer the profit to the OpCo? Yeah, that's perfectly right. The FinCo itself doesn't have any employees, so it's really an empty company which only owns assets, which has directors to sort of do what a director is supposed to do, file annual accounts and do the bookkeeping, etc. But all the services that Veronika mentioned earlier that are also provided as part of the rental agreement to the end customers, that is all outsourced from FinCo to the operating company. So actually, the day-to-day business is still handled by the operating company, the marketing, the purchase of the vehicles, the interaction with end customers, the servicing of the portfolio, i.e. Getting the cash collection and transferring them to the FinCo account. This is all done under a management agreement or service agreement between FinCo and OpCo. So I think for the time being, we covered all questions that came in.
Yes. If anyone has any other question, really feel free to send them. And Stefan, if you're still online, really feel free to add a bit more context so that our speakers are able to answer to your question. Is there any high-level tip that you want to share maybe with the audience, like one do and one don't? Oh, smart minds think alike. Thank you, Moritz, for your question.
Do's and don'ts. Well, from my side, set up your young company in a way you would a very big and very bank-like company. We at Cluno set a rule that sets with due diligence ready for everyone, either new investor or bank, within 10 days. You have all the contracts ready. You have the contracts in German and in English. You have your terms and conditions. You have someone who can present your business model, even the founders available. You can give them a run through your booking process. You have a collection policy, a solvency policy. You have your annual accounts ready, let's say by February 20th. And you have them audited not by your local whatever, but by a bigger company. It doesn't have to be Big Four, but it should not be your local tax advisor that no one knows. You have an accounting policy you can show. You have depreciation methods that are data-based and you can explain to them. You have a data tape ready of your assets, but also of your customers. You have terms and conditions in place that allow the transfer of contracts to the FinCo, because if not, you can negotiate a very good structure, and then you have to write to all the customers to please consent to transfer, and so many won't. It's basically, I believe, if you feel your business would be fit to such a structure, you should start probably 1 year in advance, setting up all internal stuff before you really approach banks, have a good pitch deck, and negotiate the conditions. And to get the best advisor you potentially could.
That's always a good idea. Maybe 2 ideas from my side. I think, first of all, it's important to think long term and to really find the best suitable financing solution for the relevant asset types that are in the company. So if you think about a company like HelloFresh, where you just deliver vegetables and fruit and stuff to customers, obviously you cannot grant that as collateral. It will already be rotten on the day after. So this is not very suitable. But if you have any assets like cars, phones, anything that has a sustainable value, then think about an asset-based lending solution. We have seen examples of companies that were jumping too quick on venture debt financing and then found themselves stuck with a tight net of covenants and security over the OpCo shares, pledges over bank accounts, etc., which made it very difficult then to add an asset-based lending solution at a later stage. So that's very important. The second advice, I think, be open, be transparent, put yourself in the shoes of your lender and look at your company and all the risk profile that you have in your company and try to address that. In the beginning, I think it's really about winning confidence and to make lenders feel comfortable lending money to a fresh startup company. And we typically start that by producing a pitch deck, presenting the business case, presenting all the methods that Veronika has spoken about, the credit and collection policy, etc., the client checks that are in place, and to make a bank feel comfortable. And then with this pitch deck, we start an interaction with potential lenders and get their feedback and views and questions. And then it's still time to sort of tailor the business and to accommodate the lender's needs. I think in the beginning, you're all in the same boat. It's really important to build up that level of confidence. That's, I think, the lessons learned from advising several companies in that space.
I guess I have one more. It doesn't ever work if you cold call a bank, and expect them to answer. So please find someone who can do an intro, and if possible, to the right people. Because the trust they might have in a legal advisor or a refinancing advisor or their current customer, you can't build up that trust immediately. Second thing, which we use a lot, we have a kind of hot questions list. Questions that are usually asked by the banks either in writing or at a pitching presentation, and we pre-word answers to them, we link them to data, and whenever the question is modified, well, we update. Because when you have 20 calls, I'd guess 80% of the questions are alike. And the sooner you get a grab on what the bank really wants to know, the better and the more efficient you can answer it. You have the right data at hand, and you can supply it afterwards. One thing that we ask a lot is, for example, retention. Well, I have a chart ready. I can ask that question on the go in a call, and I can send out that chart 10 minutes after. That's always impressive to them, because they, in their core banking system, they don't have any data available on the, let's say, 24 hours. There's always the question, who are your main competitors? Well, there should be a slide in your pitch deck, or you should be able to explain it to them and maybe even point out why you're better than them, why asset-based financing will be a main advantage in your business model. It's just probably the same your founders do when they pitch the company to investors. They have their hot question list and try to improve the answers at each go.
Love that. Thanks a lot. Do we have any last question from the audience? Suspense.
Well, please feel free to send in any questions at a later point in time. We're happy to answer by email. Please reach out to Veronika or myself, and we are happy to take it up outside of this presentation.
For sure, I'll be
I guess you have contact data at the last page. Everyone is on LinkedIn, so please feel free to connect to us.
To everyone that participated, I'll be sending a thank you message tomorrow where you'll have the contacts of Dietmar and Veronika, really, as they said. And thank you so much for that. Feel free to reach out to them. And as Veronika said, that contacts is the most important to reach out then to the banks. Potentially, you'll make some contacts after this presentation. Well, thank you, everyone. Thank you so much, Veronika and Dietmar, for this presentation. I really learned a lot, and I think the audience did too. Super clear. Really loved the whole process and presentation. So thank you so much.
Well, thanks for having us.
Of course. Thanks a lot. Have a nice evening, everyone.
See you all. Bye-bye.
Bye.
Bye-bye.